Welcome back, guys. In this lecture, we're going to be talking about Bollinger Bands. Now, what are Bollinger Bands? Bollinger Bands are just one of the multiple indicators that we have access to when we trade stocks. There's a bunch of indicators out there, and an indicator is basically just a tool that we use that's calculated based on the price and the volume of the stock, and that we can use to try and predict where a stock might go. So there's a bunch of different indicators. Again, indicators are used for technical analysis, and technical analysis is the study of charts. So charts have prices and volume. So that's the two things we can use: prices and volume. Okay. So all indicators are built with either price or volume and price. Okay. But that's really what they're built with. And we can build those different indicators to try and gauge, which direction the stock might be going. There's hundreds of different indicators out there. And to be honest, I would say more than 80% of those indicators are useless. Okay, they add no value. So you got to make sure that you're using the right indicators that work best. So in this course, I'm going to be introducing a few of the indicators that we use and that we've seen being more consistent and helping us make the most profits. So we've honestly tried most of the indicators out there, and these are by far the ones that work best. In the advanced course, I'm going to be showing a few more. But yeah, that being said, let's just start. So Bollinger Bands. What are Bollinger Bands? Very simply, a Bollinger Band is a band that's drawn around your chart that tells you that your price should remain within those bands at a certain probability. So it might tell you, hey, it's 95% sure that the stock should not go out of this band. So in that sense, you know that it's very unlikely for it to go up here or down here, right? It will happen, but it's just unlikely. Okay. Now, why would you want to use a Bollinger Band? Well, maybe you want to know when something is way overextended. So if this went down all the way here, well, is that too much? Should it come back now? If it came all the way back here, well, is that too much? Should it come back now? Here, oh, is that too much? So if you can find like a channel, but it's a moving channel with the stock that tells you within which range that stock should be, that's why you would use the Bollinger Band for. So, Bollinger Bands, and I'm going to explain the calculations, but you have to understand that different indicators have to be used under different circumstances and for different types of strategies. You cannot take the same indicator and use it across the board, across stocks, across strategies, across events. You have to have a set of an environment, a specific environment that's suitable for that indicator, right? So I know a lot of people that they tell me, hey, I like to use the MACD. So that's one of the indicators. And they just use the MACD all the time on any stock, on any strategy, no matter what's going on. It makes no sense, right? The MACD is going to be good to tell you something specific, so you should use it when that something is present, right? So in this case, a Bollinger Band is an indicator that you would want to use when you're running a mean reverting strategy. Now, we're talking more about mean reverting strategy in the advanced class, but a mean reverting strategy, really quickly, is just a strategy when you think that something fluctuates. And so whenever it goes, down here, it should come back up again. And then if it goes back up, then it goes back down, back up. So there's always fluctuations. It reverts to the mean. And when you're doing one of those types of strategies, which again, you have to do that strategy on stocks that are good for that strategy, the Bollinger Band will help you because it'll tell you, hey, okay, it's too high now, it should come back down. Hey, it's too high now, it should come back down. Okay, now it's too low, it should come back up. It's too high. So that's a very useful indicator for that type of strategy. And since, most of the stocks just fluctuate like that, this could be very helpful. So let's see how it's calculated. Okay. So first off, you have, let's see here. So if you have a stock fluctuates with time. Okay, sometimes it fluctuates less, then sometimes it fluctuates more. You can tell the Bollinger Band. The Bollinger Band has two inputs. Okay, the first inputs is how many days do you want to use. So how many days do you want to use to compute the lines that they're putting. Usually the default is 20. You can change that. And number two is the standard deviation. Default is at 2, but you can change that as well. Now, what is, and again, stick with me. You'll see that it's really not hard. It's quite simple and it makes absolute sense. So before actually I get into this, what is standard deviation if you don't know? Standard deviation is basically a measure for volatility. How volatile is it? Volatility, okay? So why did they use standard deviations? Okay, let's give a simple example, and that's one of the examples that everybody learns at school. So if I have two classes, okay, and I'm gonna draw a bell curve for probabilities. Again, you're gonna see and you're gonna understand, so don't worry if it looks a bit advanced. Okay, so let's say I have this class, okay, and the average grade in this class, okay, is 80%, and you got 90%. Okay, so let's say here the average is 80, and your grade, let's say G, is 90%. Then I have another class. This is class ABC and class X, Y, Z. So it's the same class, same teacher, but it's just two different groups, okay? So in this class, your grade is 60%. Okay? Now, that being said, or let's actually exaggerate this. Let's say you have, no, not 100. Yeah, let's say let's say you have 80. Let's say you have, let me take this off. Okay. Let's say you have 90%. Okay. If I say there's these two classes, one student here has 90% and one student here has 60%, does that mean that this student is better than this student? That this student is better than this student because he has 90 and he has 60? No. A grade by itself doesn't mean anything. The same as a price of a stock by itself doesn't mean anything, right? What you have to do is compare that grade with the group. So let's say here the group had 80%. Yeah, so 80%. And the group here had 50%. Okay. So both of them, so in this situation, the student had 10% better than the average of the group. And in this situation, the person also had 10% better than the average group. Okay. Now, can I say which student is better? Again, no. Why? Because yes, he has 10% better, he has 10% better, but I don't know how volatile the students were, right? I don't know how volatile the students were. Is it all over the place? So do I have students who have 100 and then some students who have 0 and everybody's all over the place? Because if I have a bunch of people who have 100% and 95% and then a bunch of people who have 40% and you have 90, well, you don't really stand out. You're not an outlier. But in this situation, imagine if all the students had about 50%. Some had 48, some had 52, but they're all it's very homogeneous. So they're all close together and you're by yourself above. So you're an outlier. Then yeah, you would be way better. So there's actually something that we call the standard deviation, which calculates, which looks at the dispersion or volatility between the whole sample. So if there's 100 students here, it'll look at all the students and it'll say, okay, well maybe in this situation one standard deviation is equal 10%. And when I mean one standard deviation, it means if I put one standard deviation above and below the mean. So if I want to see all the students who got between 70% and 90%, okay, that's one standard deviation above and one standard deviation below. Well, that amount should give me about 65%, okay, of the students. 65% of the students should be between that and that. So if you got 90%, okay, you know, you're good, but you could have done better. You're only one standard deviation above the mean. It's not, you're not that good. Now I can go further and say 2 standard deviation above the mean. So this would be 100% here, and then minus 60%. So between 60% and 100%, well, in this situation, you're going to have 95% of the students, okay, are going to be in that zone. So you know 95% of the students are within here. So you're somewhere here, you know. Yes, you're better than a lot of the students, you know. You're better than all these guys, but there's still people who are better than you. In the other class, where the mean is 50%, imagine that the standard deviation is actually just 5%. So then between 45 and 55%, okay, you have 65% of the students. And this is just, you know, this is how the calculation works. This is the probabilities of standard deviations. One standard deviation gives you around 65%. 2 standard deviations is about 95%, and then 3 is about 99 point something percent, so almost 100. So very unlikely to happen. Now, if you had 10% more than the group, and one standard deviation is 5%. So it's like you have 2 standard deviation more than the group. So 2 standard deviation is here, 60%, which is your grade, and 40%. Okay, so between this and this, there's 95 or 96% of the students. Okay, so when you're looking at this student, he's way better. He's way better than that student, because look at this. He's better than all these students. Like, there's very few students who are better than him, okay? Very few. But him, there's a lot of students that are better than him. So by using, you know, the standard deviation and using this table, we can gauge if a student is being an outlier relative to the mean. And it's the same thing in stocks. I can look at the stock, and I can draw a bell curve around the stock and say, you know what? What is the probability that the price of the stock remains within 1 standard deviation? Okay. Or what about 2 standard deviations? Okay. Or 3. So I can be pretty sure that the stock is gonna remain within. Let's say I wanna know the bands for a 2 standard deviation band. Well, I'm going to draw a band here, which is going to be 2 standard deviation away from the mean. So basically, I can predict that the stock is going to be within that range at that time, right? So in the same way, where I can tell if a student is being an outlier, if this is very unlikely, I can predict if the price of a stock would be an outlier if it reaches that price, right? So exact same thing. So the way it's calculated, so the way it's calculated, they use X period of days. So usually it's 20. So the average 20 last days. So they draw a 20 period moving average. Okay, and we saw that in one of the other lectures. It's a moving average, so it smooths out the prices here. And then over this moving average, they're gonna draw a upper band and a lower band. Okay, And the upper band could be 1 standard deviation above, okay? 2 standard deviations, 3 standard deviations, 4, whatever, however you want. And same thing for this one, -1 standard deviation, -2, -3 standard deviations, you choose. So obviously, if you want to have 1 standard deviation, so you're saying, okay, I wanna be sure that 65% of the time the stock should be within this range. 2 standard deviation, 95. 3 standard deviations, 99. You can say 4 or 5. So it's extremely unlikely that the price goes there. And the higher standard deviations you use, the further or the wider your Bollinger bands are going to get. Okay. Now, this is why this is so nice, because the standard deviation changes with time. So if at one point here, let's say, the stock started moving a lot, right? Here it wasn't moving and here it moved a lot. Well, the band is actually gonna adjust, okay? The band will adjust with you. So let's see here. Okay, so if this was the band, okay, so prices weren't moving a lot here, okay? So since prices weren't moving a lot, the volatility decreases. And since the volatility decreases, 2 standard deviation here is not that far, okay? So the band will narrow. But then when the stock started moving a lot, well, the standard deviation also became bigger. So 2 standard deviations becomes bigger, right? So you'll see that the Bollinger band narrows when the stock is not volatile and widens when the stock is volatile. And this is good because then if it's volatile, you know that it's more likely that it reaches one of those levels, and you want to make sure, either you're not on those levels or you want to get a position when it reaches those levels. So in this situation, you see here, the band was not too big, but then when the stock started moving, look at how the band got wider, right? Look, this is how wide the band is. And then when it started, converging again and not moving a lot, you see the band isn't that big. Here, so big. Here, not that big. Okay? So, let's check TradingView. And TradingView is super nice to use on the Bollinger Bands. So, if I'm looking at a stock, and the stock was just here, let's see. Let's say if I go to Dollarama, let's say, this is a Canadian company. Okay, why not? Let's say I'm looking at this company here, okay? And let me just take this out, okay? So if I'm looking at this company, so we go in indicators, okay? And one of the indicators is Bollinger Band. So I can put BB. A lot of people use that for Bollinger Bands, or I can just write it in Bollinger Bands. And you see they have so many different types of Bollinger Bands, so many types. That's just for Bollinger Bands, right? We use the regular Bollinger Bands, and bam, look at this. It drew it already on the chart, right? So what did they use to draw it? Let me double click on it, see the default. Okay, so the default is 20 days and 2 standard deviations. You can change that. You can put whatever you want. And you can see it does go, you'll see that the price hits these bands. And an easy strategy to do, and I don't want to say easy, but a common strategy is you find things that mean revert, or strategies that mean revert. And when the stock hits the upper band, this is an indicator for you to go short, because it's very likely, it's very unlikely that the stock should be there. It shouldn't be there. So it's very likely that it comes back. So you short here when it hits the upper band, and when it comes back to the middle point, you buy it. You cover your position, you take your profit. And when it touches the lower band, you buy it again, sell it. Same thing, buy it again, sell it. Here, buy some, sell it again. Sell, buy, sell, buy, sell, sell, buy. Sell some here, and buy again, buy. So again, you can't just do it on any random stock. You got to make sure that the stock is a mean reverting stock and whatnot, and the strategy has to be quite defined. But the Bollinger Bands will be very good for you to predict if this is a good range and the stock should be there or not, if it's likely or not likely to be there. Now, if you want if you're less risky and you only want to take very good trades that are extremely unlikely to happen, I can say, okay, well, I want to put 3 standard deviations. And look at this, the bands will widen, right? Because they're going to be 3 standard deviations away from the middle point. So if I put 3, bam, you see, they got way wider. So in that situation, you're going to miss some trades, but the trades that you get, you're going to get like this one at a way better price than you would have gotten it usually. And you're going to get this one, and you not here. So, you know, all the trades you got way fewer trades, but they're way better at a way better price. So you can decide how risky or how not risky you want to be. If I put 1 standard deviation, I'm so close, you know, it's just 65% of the time that it's going to be within it. So it's going to get out of that zone too often. So really quickly, that being said about Bollinger Bands, go play with it, see how it works. It's actually it works across products. So you could use it not only for stocks but for forex, for anything that is kind of mean reverting. And again, mean reverting, we'll talk more about that in the next class. But that being said, when you're looking at indicators, okay, look at how many indicators there are. Parabolic SAR, moon phases, Hull moving average, chop zone. Okay, so all these indicators are built with these charts, right? And often you don't even need the indicator to, you can just look at the chart, right? Just looking at this chart, I can tell when it's too down or too high. I don't need the Bollinger Bands, because the Bollinger Band, it's built by the prices of the chart anyway. So I can just look at that and predict it. It just makes it easier for me. So I don't actually have to put in the work. I'll just see it, okay? Now, there's too many indicators out there that are going to tell you different things. They're not useful for several reasons. One is because if not enough people use that indicator, then you don't want to use it. The thing with stocks is that it's based on supply and demand. Prices will move based on supply and demand. So your objective isn't just to predict, to try and guess where the stock is going, but you want to predict how other people are going to be buying and selling, because ultimately it's their buying decisions and selling position decisions that are going to affect the price of the stock, right? It's supply and demand. So how are other people going to trade that stock? So you want to make sure that you're looking at the indicators that other people are looking at, okay? Because again, the objective isn't for you to predict where the stock is going to go. The objective is for you to predict how other people are going to be acting, right? They're going to be buying or selling, because that's what's going to move the stock. So you want to look at indicators that everybody looks at, like the Bollinger Band, which is one of the most popular ones. And you also want to make sure that you're looking at something that makes sense, because you can actually come up with an infinite amount of different indicators that are going to look at different stuff. Do they make sense or not? Unless they make real sense, don't use them, okay? And also keep the amount of indicators that you use to maximum 5. Don't go over than 5, right? Because at a certain point, if you use too many indicators, you start losing value, where instead of predicting better because you have more things to look at, you predict worst, right? And that's proven in math. There's a maximum number of inputs that you can use to predict something, and if you start using more, your prediction starts becoming worst or less predictive, right? So you don't want to use too much, and make sure that different strategies have their indicators that work well for that strategy, okay? That being said, if you have questions about the Bollinger Bands or anything else, just put them down in the comments and I'll be sure to answer them. Other than that, see you guys in the next lecture.